Thank you so much, everyone, for joining us today on webinar for navigating US tax and Indian regulations for funds in Gift City. I'm Nikita, partner for US Tax Services at Grant Thornton Bharat. Today, I have with me 3 speakers joining me. Please welcome them. We have speaker number 1, Hiten. Hiten Ved, a chartered accountant and law graduate, brings 16 years of experience specializing in advising private equity and venture capital funds for conceptualization and implementation of fund structure. He focuses on setting up fund structures in IFSC Gift City and also assisting funds on tax and regulatory advisory and compliance matters during the course of their operations. Hiten will take us through the tax and regulatory landscape governing funds in IFSC Gift City. He will also dive into key benefits of setting up a fund structure and typical structures prevailing in IFSC Gift City. Next, we have with us Praveen Kashyap. He's an executive director at Grant Thornton Bharat, has over 20 years of experience in indirect taxation. He specializes in advising clients on tax-efficient structuring within SEZ, EOU, STPI schemes, and the IFSC Gift City framework. Praveen is the tax market leader for the Chandigarh region and also leads the firm's SEZ and STPI solutions. Praveen is also active on policy consultation with EPCS. Praveen will definitely take you through the concept of SEZ and various nitty-gritties around it. He will also share the industry expectations and future of SEZ. Last but not the least, please welcome Shrenik Kotak. He's the director at Grant Thornton Bharat with over 12 years of experience and 9 years in US tax compliances. Specializing in US tax matters for Indian PEVC funds, Shrenik advises on check-the-box selections, K1 and K3 filings, and US tax obligations for funds onboarding US investors, particularly in the context of Gift City. I hand it over to Hiten on that note.
Thanks, Nikita. Good evening, everyone. So today we'll first start by giving a brief overview about India's first IFSC, which is IFSC Gift City. And thereafter, we will deep dive into some of the finer aspects covering the tax and regulatory consideration involved for setting up a fund structure in IFSC Gift City. India's first IFSC has been developed considering the best practices of global IFSCs across the globe. It has a wide gamut of financial service ecosystem ranging from banks, insurance, fund market, capital market intermediaries, leasing, financing, etc. Given the diverse and the dynamic strategy it offers to the players in financial services sector, it has become a key platform for Indian as well as global financial services player to connect with the overseas and Indian market. This gained further momentum once IFSCA was notified as a unified regulator governing all the entities and units set up in Indian IFSC. In the context of fund management, IFSCA notified the fund management regulations in the year 2022 to administer and govern the fund structures in IFSC Gift City. We may want to next slide, please. Ever since its notification of the fund management regulations, the IFSC as a regulator has adopted a consultative approach and brought about multiple changes in the regulations basis the representations obtained from the industry participation. This has contributed by and is clearly visible with the significant increase in the volume of fund management activities in IFSC. In the last 15 months, the number of fund managers registered with IFSC has gone up from 63 to 143, and the total funds raised have been close to $5,000 million. We shall now discuss about some of the key regulatory considerations under the FME regulations. First and foremost, the FME regulations categorize the funds as well as fund managers into different categories. The fund managers are categorized into different categories depending on the type of funds they manage, and the funds have been categorized into different categories depending on their underlying investment strategy. There have been a separate net worth requirements prescribed for the fund management entities, which is ranging from $75,000 to $1 million, depending on the category. In case of a branch structure, there is one added advantage wherein if the net worth may be maintained at the parent level and shall be earmarked separately at all point of time. One of the most commonly asked question by most of the new players is, do I need to sit in Gift City? Do I need to relocate myself in Gift City? The answer is there is a substance requirement prescribed by the regulator under the regulation, wherein they have said you need a principal officer or a compliance officer or a both, depending on the type of registration you opt for in IFSC Gift City. Another important point which needs consideration today is the IFSCA recently has come up with a consultation paper proposing amendments to the fund management regulations, considering again lot of feedback from the market participants. One more important landmark change which has been brought about and proposed by the IFSCA is the platform play structure, under which a new fund manager may use the existing platform of a registered fund management entity in IFSC. The advantage is there is no need for them to set up a new entity. There is no need for them to have additional costs in terms of office spaces. However, there has to be a distinct compliance officer and a principal officer requirement which needs to be compliant. And there is a threshold which has been proposed of $10 million. So once the corpus reaches this threshold, the fund managers are no longer permitted to use the platform but need to have their own independent platform. We shall now discuss about some of the key tax and regulatory benefits of setting up of fund structures in IFSC Gift City. IFSC, though geographically located in India, however, from an Indian exchange control perspective, it qualifies as a non-resident. This gives a lot of flexibility for the funds set up in IFSC to undertake transactions, especially the transactions, cross-border transactions, which they undertake with the non-residents. Another advantage is for domestic funds, there has been limits for making outbound investments, which typically gets utilized. In case of an IFSC fund, they are not governed by similar limits, and that has been one of the core reason why a lot of the domestic fund managers have started setting up structures in IFSC Gift City to tap opportunities in overseas fund market. Another important development which had come this year was with regard to the participation from NRI, OCI, and resident investors. Under the FPI regulations, there has been a limit of 50% up to which the FPIs can have interest from residents, NRIs, and OCIs. In case of funds set up in IFSC Gift City, this limit has been relaxed and there can be fund having 100% money raised from NRI, OCI, and resident investors, subject to some added conditions. Additionally, there are compared to the domestic fund regime, the IFSC fund has the benefits of not being subjected to any leveraging requirement or not being subjected to concentration norms, unlike those applicable in case of domestic AIFs. We may now move on to some of the key tax benefits. Under the income tax law, there has been a tax holiday granted for units set up in IFSC, because of which the income earned by the fund management entity shall qualify for a tax holiday. Similarly, even under the GST law, there is an exemption available from management or on GST leviable on management fees and any other services within IFSC. Another important point is the comparison between the overseas fund or a structure in an offshore jurisdiction and a structure in IFSC. One of the key reasons which is dominating the offshore fund houses to consider IFSC is they need not resort to the tax treaties for the concessional tax rates and the benefits. This also brings down the risk of litigation involved, given that there will be a certainty in terms of taxation and the tax rates for the IFSC units under the Indian income tax law itself. Additionally, in case of global funds, which are typically advised or managed from India, the risk of POEM and PE exposure also gets mitigated to a great extent. With regard to the taxation regime, there is separate regime specified for category 1, 2, and 3 funds, depending on the category. In case of category 1 and 2, they are subjected to pass-through base of taxation. For non-resident investors, purely investing in a Cat 1 or 2 AIFs, for making investments outside India, there is a relaxation wherein they will not be taxed in India with regard to their income from outbound investments, merely because they have routed those investments from GIFT City. Additionally, for category 3 fund, there have been a concessional tax treatment under the domestic law wherein interest and dividend is subjected to tax at a lower rate of 10% and a capital gains exemption available under the tax treaty has also been accorded straight away under the income tax law for the units set up in IFSC and qualifying as a specified fund. We may now dwell upon some of the typical structures which are currently prevailing in IFSC gift cities. To start with, in case of funds looking to tap money for inbound investment from resident as well as non-resident investors, they can set up a fund in IFSC gift city to tap money from offshore investors alongside a domestic fund to tap money from resident investors. The reason for having two funds is because I cannot tap money in IFSC from resident investors from investing back into India owing to the round tripping issue. In this case, I can either have a parallel fund structure wherein both the IFSC fund and the AF makes investment alongside, or there could be a fund of fund structure wherein the IFSC fund will act as a feeder for the domestic AIF. The fund of fund structure has its own benefit, like the some of the requirements which are otherwise applicable for IFSC fund may not apply to a fund of fund structure, given that those have been already complied with at the domestic AIF level. Another structure which is also looked upon is for investments in by the Indian fund managers and the AMCs for investment in listed space is wherein the IFSC fund is set up as a category 3 fund for investing in Indian mutual fund, which in turn makes investments in the Indian securities. This structure also has its own tax efficiencies owing to both the concessional tax rates given to the IFSC fund as well as the tax regime available for mutual funds in India. Talking about the outbound investment strategy, IFSC fund, as discussed in the past, owing to regulatory reasons, have been looked at for tapping global markets by Indian as well as overseas fund manager. Under this structure, the domestic investors' money can be tapped at the IFSC level for investment in overseas jurisdiction alongside with the non-resident investors. In case of global fund houses, which already have offshore fund structures purely for their overseas investment, the IFSC fund can be set up as a vehicle, which would be a feeder vehicle for making investments in global fund for overseas investment. Last but not the least is an important concept of the relocation of fund. Given the numerous tax and regulatory benefits available under the Indian tax and regulatory regime, there are numerous funds who are considering to relocate from overseas jurisdiction to IFSC GIFT City. However, the benefits accorded under the tax law on relocation are only available until 31st March 2025, and hence, given the sunset clause, it is important for funds considering to migrate or relocate to GIFT City to start their discussions and the investment approvals at the earliest. Thank you.
Thanks, Athene, for wonderfully explaining the key benefits of having a fund in the gift city. Now I hand it over to Praveen for hearing his thoughts on the gift SEZ and its overall view on it. Over to you, Praveen.
Thank you. Thanks, Nikita. And thanks, Ethan, for taking us through the various nitty-gritties of IFSC. Before I come to the point, I request all participants that to make this session more interactive, if you have any question comes to your mind anytime, please do post in Q&A session, and our team at backend will try to answer them as of now. Because we know that GIFT FSCA is operating under SEZ scheme, it is imperative for us to understand what is SEZ, how it operates, what are incentive it offers, etc. So to start with, let us understand what is SEZ. In simple words, SEZ is a geographical area which is to be treated as outside of India for the purpose of tax and tariffs. In other words, we can understand it like it's an island well within the Indian territorial limits. But if you supply anything to this island, it will be treated as an export. And if you buy anything from this island, it will be treated as import for you. So that is the basic concept of SEZ. This scheme was enacted in 2006 through SEZ Act of 2005 with certain objectives, and those objectives include increasing of employment opportunities, creating world-class infrastructure in India, and to promote investment from domestic and foreign sources, among others. Let's look at some statistics. As of now, in last 15 or little more time, in India, we have around 280 operational SEZ across the location in India. And out of these 280 operational SEZs, we have around 5,700 units already operating. And in these 5,700 units, there are over 3 million people employed. With this, these are the latest information sourced from the Government of India website only. Move to next slide, please. Let's move to tax and regulatory landscape of GIFT City. As I mentioned, GIFT City is operating under SEZ scheme beside IFSCA Act. And GIFT City is a unique in its kind of operation because there is only a single financial sector hub, I may say, which is GIFT City as of today. Under this scheme, you are eligible if you decided to set up your facility, you are eligible for certain incentive. I would not repeat because Hiten has already covered some of these. You get 100% exemption from income tax for first 10 years out of 15 years. Beside this, if you import anything from outside India to SEZ unit in IFSC, it will be free from the levy of custom duties. And if you buy any goods or services from domestic market, it will be free from any GST. The only condition is that these procurement or imports should be linked with authorized operation. Authorized operation is a basically is an activity which is directly related to your business activities, excluding procurement or activities. Those are to be consumed by personnel. Beside this, there are state incentives available to units located in IFSCA, which also include exemption from stamp duty on registration, and also electricity duty exemption on procurement of electricity from state industrial or any electricity supplier. GIFT IFSC is also unique in nature because recently Honorable Prime Minister has inaugurated SWIT, which is called single window IT infrastructure. It's the first of its kind, which is in operation in GIFT City for various approvals and permissions and clearances. And that is how it is. It actually provides the real single window clearance system in place. Move to next slide, please. Recently, we have done a joint exercise, joint survey with EPCS. EPCS is a nodal agency operating under the Ministry of Commerce to help support units operating under SEG scheme. With this, we wanted to understand the challenges being faced by all these units operating in SEG scheme and what is their expectation from the policymakers. With this idea, we conducted this survey and we collated some important points which we have received through this survey. Number one is there is a requirement that whenever you buy services or goods from the domestic market, there is a requirement of endorsement of invoices from the custom officer. Sometimes it is quite cumbersome and time-consuming process. And what industry is expecting that it should be based on self-certification, and there can be verification if there is any risk arises. Number two is there is a instruction of 95/2019 which restrict SEZ units operating in SEZ scheme that they cannot have gym, cafeteria, or any recreational activities like these. And if they want to have these kind of facilities for their employees, they will have to pay taxes on these facilities. So especially in service sector, when it is very important for any organization to have these sort of recreational activities, it is quite industry is expecting that the government should come out and clarify that these activities should also be allowed, and buying of equipment and everything should be free from taxes. The third one is as of now, the definition given under SEZ law restrict any units operating in SEZ scheme to supply their goods or services into domestic market if they do not receive consideration in convertible foreign currency. Means if you supply services into domestic market and you receive payment in Indian rupees, it is a violation of the definition of services under SEG law and will trigger penal provisions against the units. So this is quite, I would say, it's not at par with the domestic units and should be done away with. This is what industry is expecting. Fourth one is a risk-based approach. Everyone, what industry is expecting that the verification of goods or services should be based on, there should be some mechanism developed by the custom authorities who are based at every SEC, and only when they find any risk, they should go for verification. Otherwise, should not be. One more expectation which we have received from the industry was that a lot of units are facing difficulties in obtaining refunds from GST authorities. Those those are operating under SEZ scheme, because there is some ambiguity in GST law, which is not completely aligned with SEZ law. So there is some disconnect between SEG law and GST law, and industry is expecting that some clarification to be issued by the government so that this anomaly can be addressed. The sixth point is that as of now, there's a default list of services. Whenever you want to procure any service in SEZ scheme, you will have to see that list of services which is allowed. If that service is not there in that list, it will not be allowed for you to procure without taxes. In a current scenario like service tax, industry is demanding that it is very difficult for us to determine what sort of services we will require for running our business. So there should be a negative list based approach wherein we should be informed that these are the 4, 5, or 6 services. Those are not allowed for business for procurement in SEZ scheme. Rest all are allowed. We can move to next slide. Future of SEZ. So there are a lot of apprehensions in India among different stakeholders whether SEG scheme will stay or will not. So we have a lot of discussion with policymakers also, and with this we may say that SEG will continue to drive the growth of Indian economy to achieve the vision of Viksit Bharat 2047. The government of India in the union budget of 2022 has announced that they will completely overhaul the SEZ law and to make it more inclusive and to achieve the purpose of ease of doing business. And they also indicated that they will introduce a new law which is called Development of Enterprises and Services Act. In short, it is called DESH. Government has also introduced a draft bill, draft DESH bill for public consultation, but as of now, there has not been any decision when it is going to be introduced. But keeping in mind that industry is expecting a long-term solution, now, as per our understanding, government is seriously considering to bring out with the new SEG law, not as new SEG law, but amending the existing SEZ law, which is called SEG 2.0. And this development will actually help achieving that there would not be any doubt on long-term policies. Means we will achieve policy stability. It will also introduce risk-based checks only, and it will focus on administration based on technology. So technology is going to play a vital part in terms of management and administration of all SEZ. Government actually is working and to an extent has achieved some part of it by integrating different portals like custom IceGate portal has been integrated with SEZ online portal. Similarly, government is also considering to integrate these SEZ portal with GST portal also. So if that happens, probably there would not be any physical documentation required. Everything would be based on technology. Beside this, government is also aiming, in line of Make in India, to develop more and more sector-specific industrial hubs in different parts and zones of India. So with this, we may safely say that that SEZ is there to stay for long term. It will continue to be the driver for the growth of India, and we will achieve a long-term, we will have a long-term policy which will be stable and out of any doubts. I will take a pause with this. Thank you very much.
Great. Thank you so much, Praveen, for putting the thoughts so concisely in front of all the participants. Really appreciate that. And on that note, I hand it over to Shrenik, and let's hear from him the US tax implications if you onboard any US investors in the fund situated in Gift City. Shrenik, over to you.
Thanks, Nikita, for the introduction and walking us through, and Hiten and Praveen for helping us on the India side. So now let's discuss about if you onboard the US investors, right? So we generally get this question. I mean, basically, you will have this question with what if we onboard the US investors, because American money will find their way and they will reach out to you that, hey, we want to invest in the US. We as a US investor would like to invest in the Gift City or for matter any other fund, whether you will be able to assist us with our US tax compliances. And they will throw a few terminology to you for the partnership, PFIC, K1, K3. And we do often get these questions from the fund houses to understand what is this terminology, what is the ideal thing which we should do as a fund houses. We don't want to get into too much of a compliance for the US entity, and we would like to understand what are the tax complications for us. So in this webinar, I mean, we are trying to cover this topics for you so that you can have this proper conversations with your US investors when it is onboarded, and also to make you understand that what you should be ready for when you are planning to onboard the US investor. So the first, ideally, this question or this terminology which you will hear is a partnership versus PFIC, whether what is the difference between both, right? So that's what I mean, the question first which comes in. So partnership is a very kind of an easy term. I mean, I would say from the tax perspective. So it's a pass-through entity or a flow-through entity in the US, wherein all the incomes of the partnership will flow through to the US investors in the same income categorization as earned by the fund. So for example, if the fund has earned a dividend or a capital gain or an interest, so it will be taxed in the same manner in the to the US investor while filing the tax return. So in the US, partnership is not taxed at entity level. So this is the benefit. So how does that make a difference to the US investor? So in the US, normally the tax rate is 0% to 37% depending on income. But where the partnership will have the age is going to be when you earn the dividend or a capital gain. So in the US, dividend or the long-term capital gain is taxed at 0%, 15%, or 20%. So 20% is the highest tax rate for this two categories of income. And that is where the 17% of that delta, which kind of comes in, and that's where the US investor is very keen on. This is, of course, the benefit of the partnership. Why they don't want the PFIC is because the PFIC is a passive foreign investment companies or a corporation. So what the PFIC means, we'll cover it, but it has a very complex in terms of the tax implication, because in some of the situation, it can be taxed directly at a flat rate of 37% along with the interest and penalties. So kind of the US tax law is discouraging the US investors to not invest outside the US, but and for that reason, this law was introduced. So and also the additional form filing requirements when those monies are repatriated from the non-US jurisdiction to the US. So the tax implication is kind of bit higher, I would say, when it comes to the PFICs, whereas in the partnership, it's a flexible structure. So basically, let's understand what is a partnership or a flow through, right? So we'll understand bit in a detail. Next slide, please. Yeah. So pass-through entity, also known as a flow-through entity. So as I mentioned, that the income deduction and also the one of the very good advantage for the US investors is the foreign tax credit. So any, I mean, depending on the category of the AIF you are, I mean, if any withholding has been done or any taxes which has been paid by the fund, that also credit, their share goes to the US investor and they will be able to take the credit. So that becomes another added advantage for the US investors to claim such credit. And it also becomes your selling point to the US investors. Ki we are the partnership for US tax purpose, and we can offer you this K1 forms, which is required for your US tax filing. So the partnership will have that age over the PFICs, whereas in the PFIC, as we mentioned, that the income can be taxed at 37%. There is no 20% tax rate for the dividend or the interest. And also when this money is repatriated, say for example, over the period of time, this money has been accruing. So once that money has been accrued and paid back to the US investor, the PFICs will have the implications upon such distribution, but whereas there are high chances that in the case of partnership, there may not be any tax to the US investors upon such distribution from the partnership. So that is the reason you will hear that your US investors will insist on getting you this partnership or the pass-through status for their US tax requirement. So let's understand the entity classification. How does that work in the US? So if you can go to the next slide, please. Yeah. So the US tax law, has defined that how this eligible entities will be work, right? So the US tax law is defined into two buckets: domestic eligible entities, foreign eligible entities. Since we are talking about the Indian funds here, so we'll discuss about the foreign eligible entities. So the US tax law has defined that if all the shareholders or the partners or the members of that foreign entity has a limited liabilities, then for the US tax purpose, you will be by default considered as a corporation. So, irrespective of your local categorization, that whether you are an LLP or a business trust or a company, for any matter, for us, you will be considered as a corporation for tax purpose. So that's how they have categorized that if any of the member has unlimited liability, then a partnership. If all the member has a limited liability, then by default you are a corporation. So technically, once you onboard them, the US investor, your fund will have a limited liabilities, and that is the reason the fund will be categorized as a corporation, which they will not like it. So whether now the question is whether you can change this. So yes, there is an option to change that, which we call it as alternate or check the box or election also, which is commonly known as. So you can change this status from a corporation to a partnership or a partnership to a corporation by following the process, which we'll discuss in the next few slides. But yes, that is a possibility. Now, assuming suppose, you are not doing this check the box election. So what is this will lead to US investors? So there is a PFIC test, which you have to do. So the PFIC test is also defined in the law as this two test. Test one, which if you have an income from the passive category of more than 75%, or if you hold the passive assets of more than 50%. So, now the funds are into the business of doing this investment. So there are bound to be this PFIC, and the tax implication for the US investors are going to be high for that matter. And they are not going to like it, because you will be treated as a PFIC for them, and they may not want to invest in your fund because of the high tax delta as compared to the other partnership structure. Again, now there is another important why this PFIC test is going to be, even say, for example, if you changed your status to a partnership, right? So then you say that, hey, I want to change my status from a corporation to a partnership, but still you need to do this test for your portfolio companies, because that fund has become a transparent or a pass-through entity, and now you will be investing on the portfolio companies. So you need to do this test each year for your portfolio companies, and you have to make sure that none of your portfolio companies are a PFIC for that matter. There are high chances that, say, for example, if you're investing in active entity, they are not going to be in this category. But you have to do this test, and if any of the, by any chance, if your portfolio company is falling under this category, so you need to report every year to the US investor that, hey, this portfolio company in which we invested is a PFIC for the US tax purpose. And there is once a PFIC, always a PFIC rule. So next year, even if you don't fall in this category, then also you need to ultimately report it to your US investors. So I mean, yeah, the PFIC test is a very important to be done for your portfolio companies each year, and you need to report it to your US investors. Yeah, moving on. Yeah, so now let's understand. So, okay, now we understood what is corporation, what is partnership. So, okay, now I want to change this corporation status to a partnership. So what should I do? So the process, like in the India, we have the PAN card number. In the similar way, we have the EIN number in the US, which is an employer identification number. So that you need to first opt in. After that, you need to file the form called Form 8832. If you can just go to the next slide, please. Yeah, so this is the form. So this is the form wherein you say to the IRS that, hey, we are by default a corporation and we would like to change ourselves to the corporation, sorry, to a partnership. And this is our Form 8832 signed for your records. But the only catch here is that you have to be a partnership for next 5 years. So you cannot after 3 years, say, for example, your US investors are not there and you want to get back the corporation status, then it's not possible. So the 5 years is the kind of lock-in period. And the timeline also to file this form is the 75 days from the date from which you want to make it effective. So technically, if you want a 1st of January 2024, then you should be, or you should have filed this form by March 15, 2024 to change this election. So from whichever date you want to make this effective, ideally within that 75 days, you have to file this form. So it's a one-time exercise, getting an EIN and this form 8832. Say if you don't want to change it for 10 years, 15 years, then you can keep it as a partnership status, but you don't need to file this form each year, and it's a one-time exercise. Moving on to the next one. Yeah, so very popular form, Schedule K1, K3. You will hear this a lot from your US investors. What is the Schedule K1, K3? So Schedule K1 is a per US investor form which you need to. So if you have 10 US investors, then you have to prepare 10 K1s. And you have to prepare 10 K3. So I'll first explain what is K1. So K1 is a prescribed form by the IRS wherein you give all the information about that US investor, say name, his SSN number, address, his tax basis of capital, his share of income, his share of credits, all the other information which you are supposed to give with the K1, that is the form K1 which you will be giving. The Schedule K3 was recently introduced in last 2-3 years. So this form was introduced to standardize the foreign information reporting for the US investors. So earlier, when this form was not there, all the funds were reporting in their own manner, and it was creating a big issue for the IRS in terms of getting the information. So they introduced this form Schedule K3, wherein you will categorize whether the income of the fund has been, it's a US source, non-US source, credits, for which bucket this credit, whether it's against the capital gain, whether it's against the interest. So all those detail form, all the PFIC related information and everything that will go into that form. So the idea behind this Schedule 3 was they wanted to standardize and also get the detailed information about the foreign informational filing. Foreign informational filing is a very crucial forms for the US investors because the penalties are high and it can go to up to $1 lakh. So they would not want to get into such trouble. So that is the reason it is important that Schedule K1 and K3 has to be issued on an annual basis. So ideally from the deadline or the timeline perspective, I mean, I would like to highlight or clarify on that front that if your fund does not have any US effectively connected income, technically you are not going to file this form with the IRS. So it is called a pro forma K1. So you are giving the draft K1 or a pro forma K1 to the US investor. So the US domestic law states that a partnership is not required to file the tax return in the US unless and until you have effectively connected income in the US. So technically, you are not filing or you are not required to. So as such, there is no due date for you if you do not have the ECI. But having said that, your US investor will have the deadline. So for them, you have to kind of give this form by March 15 or an April 15 for the individuals in the US. April 15 is the deadline. If you have the LLCs who have US LLCs who have invested in your fund, then they will have a March 15 deadline. So it depends on your investors, or how well you are comfortable with your investors, that when you have to give the K1. So as such, there will not be any technically a deadline for the K1s, but this may be the timelines for you to give them the K1s. Moving on. Yeah, so this is an additional reporting. I mean, this kind of goes, along with the K1 reporting. So, considering the time constraint, and we would like to have the Q&A answered, so I'll take 2 to 3 forms just to explain you quickly which are the important ones. So it says Form 8621, 926, and Form 8865. So 8621 is what we discussed about that PFIC, right? So the PFIC, if the US, these forms are required to be filed by the US investors. So this form, you are not required to file it technically. So this form, but however, to help them filing or to facilitate them file this form, you have to provide them this information, so that, because this information, you as a fund will have it. So form 8621 is more reporting of the PFIC. So as we discussed earlier, if any of our portfolio companies is a PFIC for tax purpose, then you have to give the information about your portfolio companies in the PFIC sections in the Schedule K3. So that form will be important from the PFIC perspective. Form 926, another very important form from the US investor perspective. So when the US investor has invested in your fund and you have invested further money into the portfolio company, so they are required to report that indirect investment also on their US return. So you as a fund is bound to give that information to them, so that they will know that you have a reporting obligation for this. But you don't have to give it for each year, only in the first year of investment. Say in the first year you have invested, and you have given that we have invested in this, and the next year you don't need to give any status or anything about it, and they are not required to file it for each year. So in the first year of investment, give this information to them. Form 8865 is for the investment in the foreign partnership. So if you have changed your status from a corporation to a partnership, so that US investor will have to file this form for investing in your foreign partnership, which is in your fund. So for that, you will have to give them the proper information so that they can file this form along with the tax return. So these are the 3 critical forms which we come across on a daily, or I would say very frequent to be reported by the fund to the US investors, along with the K1 and K3. Coming to the last part, how we can help you. Can you just go to the next slide? Yeah. So whatever we discussed until now, we can help you whatever for the entity classification, K1, K3, PFIC evaluations. Also the FATCA and CRS part also that needs to be taken care, because now since you have the foreign money in your cap table and everything, so you have to be very mindful about the FATCA CRS compliant, which you are doing it. So we can help you on that aspect as well. So I will hand it over to back to Nikita, and we'll start with the Q&A.
Thanks, Shrenik, for that. And in the interest of time, I'll quickly take a few questions for Hiten and other speakers. And to begin with, for Hiten, your first question is, somebody said that the principal officer and compliance officer need to be physically present in Gift City. However, in a feeder fund operating out of Gift City, what are the requirements? Since, sorry, my chat got hanged. Since the EO and no, I can't see what are the requirements since the PO and CO operate where the master fund is situated? Your thoughts on this, please, Hiten.
Sure. As I mentioned earlier, the substance requirements of PU and CO are a mandatory requirement irrespective of the fund structure, whether you are a fund of fund structure or a direct investment structure. In both cases, you will need to comply with the PO and CO requirement depending on the type of category which you opt for.
Great, thanks, Hiten. Next, we have one more question for you. Can domestic investors remit money to IFSC without being subjected to LRS?
So, with regard to investments in IFSC, firstly, under the OI regulation or overseas investment regulation, the conditionalities and limits shall apply, which in case of an individual is LRS, and if it is a non-individual or an entity, the limit prescribed is 50% of the net worth of the entity.
Great. Thanks, Hiten. I'll take one more question for you because there are many from this perspective. Regarding Regulation 32 on eligible investors, it states the minimum threshold does not apply to accredited investors, nor to employees, directors, or partners of the FME. Can a fund accept contribution or so?
Yeah, so for the accredited investor, there is no threshold. So one of the relaxation is that in case specifically under Regulation 32, which is for non-retail category, there will be no threshold for an accredited investor, and therefore there is no need to comply with the minimum amount. And for employees of the fund management entity, there is a lower threshold prescribed of $40,000.
Great. Thank you so much, Hiten. And for other questions, we'll definitely come back to you with a detailed answer. But in the interest of time, I'm going to take a few questions from the US tax perspective. And Shrenik, on that note, my first question to you is, can you please once again explain the basic difference between K1 and K3?
Sure, Nikita. So basic difference between, so K3 is an extension of an K1 technically. So K3 is only technically required to be filed when you have a foreign information to be reported. So, I mean, looking at or the agenda of this webinar, I mean, we are talking about the Indian fund. So from the US perspective, we already have the foreign presence, right? So that K3 form will have the categorization between whether what is US, what is non-US, what all forms, additional foreign informational forms which a US investor is supposed to file. So this 8865 form which we discussed, this 8621 form which we discussed, all that information will go into that Schedule K3. So this is that the standardization that has been done by the IRS in this Schedule K3, and the idea is that the information should be given to the US investor in a proper manner, and what all information should be given. So IRS has standardized that.
Oh, great. Good to know, Shrenik. Next question I have for you is, if let's say if there's a long-term capital gain from an investment in US company, do you think will this get classified as income from US and it requires filing of return in the US?
So it has to it has to be looked at on a case-to-case basis, but prima facie was, if you ask me, considering the sourcing rule, it might not require you to file it, because the US domestic law on the sourcing of the capital gain states that where technically you are the resident for the tax purpose, that's where the sourcing will rule will apply. So if you are an Indian resident, and the Indian fund, technically, there might not be any US filing requirement, because it is not a US source, but India source income.
Great. Shrenik, one more question for you.
Sure.
And in the interest of time, then I move to Praveen. You mentioned that, there is a time to file Form 8832, which is 75 days.
Correct.
Is there any other relief election if somebody doesn't file those forms in the time given authorized by the authorities?
Yeah, I mean, looking at this webinar, I mean, many of will have a question that we want to do it now from the 1st January. So there is a late election relief which has been given, stating that if we can prove that ideally we did not know and we would like to go ahead with the election from January 1st, I mean, and we were not aware about this. So it's a more of a relief appeal which you can do it to the IRS. And in our case, generally it gets approved. In our experience, we have not seen IRS rejecting it, but IRS do have the authority. But yeah, we do have the option to file a late relief election for this matter.
Thank you so much, Shrenik, for your inputs. Last but not the least, Praveen, let's hear. We have some questions for you. My first question is, it says that while the government is making changes gradually to SEZ laws, it's important to note that there has been no announcement regarding the introduction of SEZ 2.0. Does this suggest a further delay in the rollout of SEZ 2.0, which is a key concern for all the members attending this session? So what are your thoughts on this, Praveen?
Okay. So right now it would be too early to say that the government is delaying the SEZ 2.0. As we all know that the government is working on it. The government is taking stakeholders' suggestion and there is an active discussion and feedback to ensure that all the issues which they are currently facing can be addressed in the proposed SEZ 2.0 scheme. Moreover, we anticipate that proposed SEG 2.0 will address all the major concerns of the sector specifically to promote ease of doing business and to achieve motive of making Atmanirbhar Bharat.
All right. My next question to you is, someone just mentioned on the chat stating that filing both SEZ and GST compliances, whether monthly or annually, they often result in duplicated efforts and additional time and a lot of paperwork as well. So what are your thoughts on this?
Yeah, this is a fact. A unit operating in SEZ will have to do multiple reporting to multiple authorities, and this because of multiple reporting arises from the separate jurisdictional authorities. As there is no sync, and during my interaction, I mentioned that government is actively working to integrate different portals together so that this sort of duplication can be avoided. And we hope that with announcement of SEG 2.0, all these issues will be addressed or eliminated.
Great. Thank you so much, Praveen, for your input. And on that note, we will wrap up our webinar for the day.
Nikita, sorry, I think there was one more question in Q&A. Probably I would want to take it up. It was very
Sure.
interesting.
Sure. Please, Praveen, go ahead.
Okay, I think someone asked this question that can they set up hotel or apartment in SEG and still they can be eligible for tax exemption under 10A. To answer this question, we need to understand the concept of SEG. Normally, all SEZs are divided into two parts. One is allocated only for the core business activities, for which that particular SEG is designed or developed, like IFSCA. In IFSCA gift city, only units those are in financial sector are allowed to operate. And there is a area outside of that IFSCA which is available for anyone for any commercial activity, but on which no tax concession is available. So to answer this question, for these activities, no concession is available, no tax exemption is available.
Thank you, Praveen. And on that note, we will wrap up our today's webinar. For the questions we couldn't answer right away, but we will definitely come back to you with a response on the same. And thank you so much once again for joining us, and a huge round of applause and thank you to all the speakers. Thanks a lot for your time.
Thank you.
Thank
Thank you
you.
so
Thank
much.
you, everyone.
Thank you.
Thanks, thank you.